Hey guys, welcome back to Lauren's Reality. I am Lauren, as usual. This week we want to talk about mortgages. I know mortgages are not the most fun thing to talk about. We're gonna split this into two different episodes, so make sure that you watch both of them because they'll both give you the right type of insight into the business. Anyone that is out there that is trying to buy a home, sell their home and buy another one, get a second mortgage, refinance their home, do any of those things, if you've had to navigate the realm of mortgages, it can be very confusing, and there's not a whole lot of education or feedback that you get unless you get a great mortgage lender. And there are great lenders out there. So the first thing that I want to say is one of your top priorities, regardless of what you're doing with any type of financing, you need to find a really good lender. And a lot of people don't realize that you are able to shop as many lenders as you want. So unlike if I'm gonna go shop for a car, if I wanna go buy a car, if I go talk to 5 different banks or 5 different dealerships and they all run my credit to see if I qualify for a car, those are gonna be hard hits to my credit, which is a bad thing. It can make your credit score go down. But housing is different, and that's because of the Consumer Financial Protection Bureau, or the CFPB. They have protections in place to allow you to shop as many lenders as you want. At the beginning, they only do a soft pull to your credit, meaning that you don't have an impact to your credit score, unless you do it like 10,000 times, which I don't even think is possible. But you are able to find the best rate, find the best lender, and you want a lender who, even though they don't perform as fiduciaries, will guide you through the process and give you the education that you need to make an intelligent decision. But if we're living in the realm of the real world, which is what I suggest, then you should educate yourself. And that's a part of what we want to do here. So the first thing that we want to talk about in this episode is what is a mortgage, what type of mortgages are there, and how should you look at different products or things that are available to you. So to answer the question, what is a mortgage? A lot of people use it in the terms of like you're going to get a mortgage. Technically, the mortgage is your promise to pay. So the bank is gonna give you money to put in your account or to buy whatever with, but you are giving them a mortgage, which is a note saying that I promise to pay this back. Depending on what state that you're watching this from or that you live in or you're looking at buying, there are 2 different types of states. There are title theory states and lien theory states. And there's a big difference in how your mortgage is structured. So whenever you are in a title theory state, North Carolina in the Southeast is a good example, so is Florida. These states are much like a car in terms of I get a loan on the property and I still have a mortgage, which is my promise to pay. But the difference is that I'm going to close the loan through a title company. And through that title company, once it goes through, your actual deed to the property, so what shows that you have ownership, is held in limbo, and you don't get the deed to the property until you pay off the loan. And it's held by a third-party intermediary, the title company, and you can't actually do anything without paying off the loan, which is normal, right? But the big thing to understand there is that the foreclosure process in those states tends to be a lot faster, and no one intends to go negative on a loan, but because it's held by a third party, unlike the lien theory state, then you have the ability to kind of have paperwork filed against you faster, I guess would be the best way to put it. If you were looking at a lien theory state like South Carolina is, for example, or Georgia is, then you get the title to the property at the moment in which you sign the mortgage. So as soon as you make your promise to pay, they paid for the house with the money that you got from the loan, then you get the title immediately. And what that means is that in order to get the property back from you, so if you were to default, they have to sue you to do that. These are called judicial foreclosure states. The reason why this is important is to know what protections you have and what methods you can go through if you felt like you were being foreclosed on for the wrong reason. In a title theory state, you would have to go through the intermediary. In a lien theory state, you would have to go through the court system. So there are two big differences in those types of states. In terms of your products, there are an overwhelming number of mortgage vehicles. And when we look at the different types, it can be very confusing. Most people only really know of two. One is the old school version. A lot of people, even today, when polled, think that you have to have 20% down in order to buy a house. That's not true anymore because of government-backed loans that we'll talk about in a minute, but a conventional loan is what they're referring to. Those loans are typically 20% down, but they go as low as 5%. And what makes them vastly different from any government-backed loan is that they're privately insured. I am a huge proponent for conventional loans because of that reason. The secondary mortgage market, which we'll also discuss in just a minute, is what has to exist with government-backed loans. With conventional loans, you're paying your own mortgage insurance. So mortgage insurance is required on those products because in the government space, the government is the one actually backing your loan. So if you default on the loan, the insurance is paid essentially by the government. On a conventional loan, you are paying for your own mortgage insurance in the case of default. And the reason why I believe these to be better is one, it encourages a larger down payment on a home, which we're gonna pause there for a minute. We're gonna cover this more in the second episode, but in any chance that you're able, if you can put a good amount of down payment on a property, I would say 10% or more, then that is ideal. We're gonna discuss why, like I said in the second episode, but that's something that has become less and less of a forward thought with people. Because there are products available that you can do 3% down, and you can even get that money as a gift, then those products are pushed, and the public, if I say, hey, you can either pay $20 or you can pay $2,000, more than likely you're gonna wanna pay $20, right? But is that what's best for your total financial outcome ultimately? In most cases, it's not. And the reason for that is if you look at the financial crisis, people who did not put money down on properties foreclosed at a higher rate or did short sales at a higher rate than those who didn't. And that's a very clear evidence that if I buy a house right now at the peak of a market, let's say the market is really hot and I go out and I buy a house for $200,000, then it goes down. So the market collapses like it did in the housing crisis, or for any reason there's adjustment in values in an area. If I had little to no money into the actual property, I have no equity in the property. So this will result in negative equity. So now the house is worth $180,000, but I still owe $200 on it. These are situations where you have to do short sales and where things get a lot more complicated. So my advice is always plan ahead and have money to put down because it puts you in a better situation overall. But let's go back to the types of products. So we had conventional, which is I'm gonna pay my own mortgage insurance. I pay that up to 20%. So once I have 20% equity in the home, then that mortgage insurance, I can ask for it to be removed. They won't remove it for you until 22%, but I could ask for it to be removed like right as soon as it hits 20%. A lot of people do this through like requesting from the lender to have a valuation of the property. But just know that once you reach that point, you no longer have to pay PMI. And what you really want to focus on is getting yourself to a position where you don't have that payment because one, you have no more PMI, which is not a huge payment, but it's still additional to your mortgage. But 2, you have at least 20% equity in your home, which is a very safe place to be. That means you essentially have savings baked into the value. On the other hand, we have more of your government insured mortgages, which would include, you've heard the terms FHA, VA, USDA, all of those things fall into the government-backed mortgages. What makes these products really unique is that the government is basically paying to ensure that you won't default. And they were created for a really good reason. If you looked at the history, we did the series about the history of real estate. And in that series, we talked about why FHA mortgages came about in the first place. This was after the Depression, the Great Depression, and everyone needed to be able to get a loan. Their credit was hurt, their income wasn't what it used to be, they didn't have as many assets. And so the government was like, we need to step in here and help people get into houses. So it was really meant to be a temporary product that we've just kept forever. And the risk associated with those, in my opinion, is because now they have to incorporate what is called the secondary mortgage market. And the secondary market buys these government-backed loans. If you've heard of Fannie Mae, Freddie Mac, Ginnie Mae, the third sister no one's heard of, all of those that end in May or Mac are government-backed secondary market buyers. So they essentially buy these huge pools of mortgage loans and they replenish capital back to the banks. So the bank has little to no risk, which has resulted in the qualifications for a lot of these government-backed loans to be lower and lower. So now I'm seeing products again out there where you can get a loan with a 580 credit score, a 540 credit score, with previous foreclosures on your record or bankruptcies on your record. And I may have the unpopular opinion in a lot of cases that not everyone deserves to own a home. And when I say that, I mean not everyone deserves to be put in that risky of a situation, because we're not giving enough education as to what people are actually committing to. And with all of these different loans come risk. If I'm going to get an FHA loan that I only have to put 3% down on, for example, this loan is, I could go to my mom, my cousin, whoever, I could get them to give me that 5% or 3% down as a loan or a gift, and that also counts. I can have very low requirements. And in the next episode, we're going to talk about how they look at what you can afford, which is even more dangerous because you could end up buying at a level that is higher than your actual housing affordability. When you are shopping these different loans and you're trying to decide, okay, more than likely the lender is going to say there's conventional, there's FHA, and if you're in a rural area, they may present USDA. And USDA is similar to VA loans. If you're in the military, you know what a VA loan is. If you're not in the military, it doesn't apply to you, so don't worry about it. With USDA though, anyone can qualify as long as it falls within the mapping of a rural area, or what the lender considers to be a rural area. Those mortgages require 0% down, so you don't even have to put a down payment. And they're very attractive to buyers, obviously, because once again, if I say you can pay 0 or you can pay 10,000, you're gonna wanna pay 0, right? But you have to know going in what the risk associated with doing that is. Once you've made a decision on which direction to go, they're also gonna ask you how long you want your loan to be for. There's 15-year mortgages, there's 30-year mortgages. And in the majority of cases, lenders are going to most likely push you towards either a conventional or an FHA loan that's a 30-year note. Those are our most common mortgages here. And that's just because that's the most common product that they push. When you're looking at what's best for you, you need to know like what your payback is gonna look like. So how much your mortgage payments are gonna be on a continued basis. You need to know what recourse they have against you for default. So you wanna make sure that your mortgage doesn't have anything like prepayment penalties in them. So if you paid off your mortgage early, you wouldn't be penalized for that. And there's a lot of things that go into making a decision that is more than just what is the lowest monthly payment I can get per month. This is why adjustable rate mortgages versus fixed rate mortgages became such a hot debate around the housing crisis. Because if you have a fixed rate mortgage, everyone thinks that has to be better, right? There can't be anything better than a fixed rate mortgage in any given market, which is not necessarily true. It depends on how long you're holding the property for. So an ARM, for example, the adjustable rate mortgage, will adjust at preset periods. They can be 5 years, 10 years, 15 years, whatever style ARM you get. So the mortgage interest rate is going to stay the same until that preset period, and then it will adjust to whatever the market rate is at that time. The benefit to these is if I buy a house right now and I want to, let's say, I know I'm not going to live in it more than 5 years. So my goal is I'm going to live in it for 3 years, let's just say. I'm going to sell it and then I'm going to buy something else, or I know I've got to move on with my career or whatever the case may be. In those situations, an ARM may actually be of more benefit. You should weigh those options because the ARM itself is going to, yes, adjust at a certain rate and time, but if I am planning to exit the property, my interest rate at the beginning of that loan will be lower than what I would get with any other form of fixed rate mortgage because it's actually based on the current interest rate in the market. There's a cushion put into fixed rate mortgages to account for inflation and other things. And with interest rates being like still at historical lows, then you shouldn't be as interest rate conscious and more conscious about the vehicle of the loan and what that can do to set you up to meet the goals that you have. So make sure you have a lender that will talk to you about your goals, know what you need to accomplish, and find you a product that will fit what you need. Keep coming back for more episodes. Make sure you definitely watch the next one. I want everyone to watch that one that possibly can, because we're gonna talk about how to figure out what your housing affordability is, which is massively important. Make sure that you hit the bell, subscribe to the channel, and keep coming back every week. Thanks, guys. Bye.